I may have mentioned this in the very first week, and if I didn't, I do apologize, but there's a Netflix documentary that if you get a chance to watch, I would highly recommend it. It's called Something Ventured. And it's a history of the Silicon Valley, but told through the eyes of the investors and the entrepreneurs themselves. And this is a very short clip. So you're going to find that this clip kind of abruptly ends because we don't have time to show the whole thing. And this will be quite self-explanatory, so I don't need to give it much of a intro. And so we'll kind of look at this, and then as people come in, then we'll get started with the main content today of what we're going to do.
In 1976, the only people who believed in a personal computer were the geeks and nerds who gathered at homebrew computer clubs. At one such club, 21-year-old Steve Jobs had partnered with Steve Wozniak to create a circuit board kit they called the Apple I. Steve Jobs was working at Atari at the time, so the most obvious person to ask for startup money was his boss, Nolan Bushnell.
They needed an investment, and they offered me a third Apple computer for $50,000. And I said, gee, I don't think so. I could have owned a third of Apple computer for $50,000. Big mistake. But I said, call Don Valentine, because Don had a high probability of seeing the opportunity.
So we had our meeting. I went to Steve's house and we talked, and I was convinced it was a big market just embryonically beginning. Steve was in his Fu Manchu look, and his question for me, tell me what I have to do to have you finance me. I said, we have to have someone in the company who has some sense of management and marketing and channels of distribution. He said, fine, send me 3 people. I sent him 3 candidates. One he didn't like, one didn't like him, and the third one was Mike Markler. Mike Markler worked for me at Fairjob before he went to Intel.
He called me up and said, there's 2 guys over in Los Altos that could really use your help. And you ought to go see them. I said, okay. Because that's what I did on Mondays. I was retired. I think I was 32 and I retired from Intel. But 1 day a week, I would help people start companies and write business plans. I did it for free, just from the interaction with bright people that had a lot of fire in their belly. So I went over and talked to the boys. The 2 of them did not make a good impression on people. They were bearded, they didn't smell good. They dressed funny, young, naive. But Woz had designed a really wonderful, wonderful computer technology that was really advanced. The problem was, you could walk down the street in 1976 and talk to 100 people and say, would you like a personal computer? And they go, well, what's that? And so I told them, I said I'd help them write a business plan. So I got to working on it. And I said, gosh, the opportunity here is just too great. The business plan said that with $142,000, we could be cash flow positive in 9 months. And I came to a conclusion that we could build a Fortune 500 company in less than 5 years. I said I'd put up the money that was needed.
Not only did he write the check, Mike Markler came out of retirement, becoming the president and CEO of Apple.
Well, of course, you can see that that's the 2010 market value, and for those of you who haven't been following, is at Apple is on their way if they continue to deliver the value that they have up until now of being one of the first trillion-dollar companies. That is, if Amazon doesn't surpass them first. But the reason I wanted you to see this is because it just goes to show you that you know, some of the startups that we work with, oh, there we go. Some of the startups we work with are things that where we can know a lot of things about them, that we're treading very established ground. We're improving upon things that already are. But a lot of the kind of things that have changed the world, the Apples of the world and Facebooks, there isn't much to really go on. How do you really, as he said, if you walk up to a bunch of people and ask them, do you want a personal computer? They can't always tell you what they want. So this week, it's we're going to be focusing on about the finance for your startup, because we've gone in the first week to the ideation, to then putting it on paper on your business model canvas. We then talked about intellectual property and how to think about how to protect your ideas. And this is going to be all around how you kind of fund and finance your ideas. But as we mentioned to you, this is not going to be heavily focused on what is a term sheet, what are the terms in a term sheet. There's lots of other programs that do that. We can provide you lots of materials. In fact, we've created a resource library that at the end of the class we will give you access to, that will have a lot of blogs and articles and other presentations that talk about more of the details, the things you can kind of learn on your own. Today we're going to talk about some of the more human elements of getting your company financed. And so I encourage you, if you have questions, to be very interactive, to jump right in. Don't wait for me to necessarily pause, just throw up your hand and we'll kind of go from there. And before we even start, does anyone have any questions from the previous weeks or anything that they wanted to ask before we kind of jump into this today? Okay. As always, you can always talk to us either offline or after class. The finance world, the world of investments. The reason we have this particular slide, it's a great way to get kind of acclimated between risk and reward. Because when you think about the financiers in the innovation ecosystem, you have entrepreneurs, you've got service providers and consultants, you've got support people, you've got mentors. But the investors in the ecosystem have some of the most transparent motives, usually. Usually they want to invest in your company, not only because they believe in you, but they really hope for some return on their capital. Now, some, of course, are doing it for other kinds of impact. We'll talk about that. But by and large, a lot of these investors are looking for a return on their capital. And so for them, it's a risk-reward calculation. So in the lower left-hand corner of this particular slide, you can see that we have some of the safest investments, the things that are usually backed by real tangible assets, and you're borrowing against those, which is debt, all the way up to the higher upright, where you're asking to sell part of an idea and the potential of the idea. And so people have to be betting on you and your ability to execute on that. And everything in life is a risk-reward calculation. And this just goes to show that a lot of people say, well, why venture capital? Why is the investment? And we're going to use venture capital in a very broad term. As you will see in several slides, we're going to kind of break the whole capital conversation into many pieces, and not all of them will be venture capital. But startups have the potential to create a lot of new jobs and economic impact in the world. And very much, when we saw the previous slides, when you are professional investors, and particularly people who manage large pension funds or large endowments, and they have to take all of that capital and invest it in ways to make money back, they tend to only invest a very small percentage of things in the really risky things, and they tend to then balance it out, what's called portfolio diversification. They tend to invest it across the spectrum of risk and reward, just like you may do in your own personal investments, where you may buy some very interesting stocks that may be very risky, and you may put more money into things that are safer bets, and you can hedge one against the other. But Kauffman Foundation, which is an entrepreneurship foundation out of Kansas City, Missouri, did a report several years ago that found that the majority of net new jobs in the economy were actually created by startups, not the big companies. And of course, we often see that played out. So these are huge economic engines for the regions, or startups are. And very often the argument for investing in startups is not what do you lose by investing in these companies, but what do you lose by not investing in them. If you invest a very small percentage of your portfolio in something high flies and it kicks in, it's kind of the lottery ticket. It has the potential, but unlike a lottery ticket for which you have no control, in the investment world, we think that we do have some control over the exits. We can help engineer things, we can help add value to companies as investors, and so that's why we do it. We see the potential in the people and the idea, and we think we can work along with the teams to make that happen. And if you look at 100 years, the last century of America's top company, the thing that really comes out as a shock is that a lot of the companies that now today sit at the top of the largest companies in the US didn't even exist 20, 30, 40, 50 years ago. A lot of them have come into being very recently, and particularly those that sit at the top of like the S&P charts. So that's something that people really are intrigued with, is we got these companies that are no longer dependent upon physical geography or even being next to an oil well or a copper mine or near strong real estate, airports and highways. They just have to go where smart people are. And the extraction is not the resource itself, it's the knowledge of the people. That's the new input for these companies. And that's very interesting for a lot of economies, because you can scale and create a tremendous amount of impact across a wide that's disproportionate to your digital or your physical footprint. So you can be a very small country or a very small geography, and the region can create a huge imprint on the world. And think of places like Israel, that's very, very tiny, it has a huge economic impact on the world. And the Silicon Valley, as a region, isn't terribly large. It's not larger than a country, and yet the economic impact it generates is quite large. So everyone's trying to recreate that. And it's manifested in these types of companies that are being created. Now, when you look at the early stage investors, so we looked at the companies that have been big. These are the investors. Now, one of the people you saw in that brief little video at the beginning was Don Valentine with Sequoia. He's one of the true rainmakers of the venture capital field in the Silicon Valley. You're going to hear us talk about a few others. And what's interesting about them is, of course, Sequoia has had a number of very, very big billion-dollar plus exits, and that's what their investors really like for them to do. And it seems like they have a very interesting, quote, algorithm, human algorithm, in their head, because no one's been able to create like a mathematical algorithm. Now, when you think about it, in more mature companies, we can look at cash flows and inventories, we can look at customer pipelines, we can look at a lot of signals that give us comfort in terms of how the companies are going to grow. And companies such as like Berkshire Hathaway rely on a lot of that research and understanding of companies to be able to get comfortable with their prediction of how they go. So these are models of predictability and probability. But when you're working with startups, particularly very nascent and emergent startups, really what you're focusing on is what is possible or what is plausible, and then trying to unlock that potential from the company and unleash it on the world. And some of these firms like Sequoia and NEA, Kleiner, Excel, these folks have done a much better job of doing it than other people. And so what we find is that there's a disproportionate impact from a very small number of funds. In fact, the vast majority of venture capital funds and investment funds out there actually never return investment back to either themselves or to the investors in their fund. And so it's only a very small percentage that actually create the impact. And these are the actual, this is looking at the highest venture capital backed exits of all time. And you recognize many of the names on there. I will give these slides to you so you can look at them, because some of them are not necessarily household names. Some of them come from Asia, some of them coming out of the very specific healthcare field. But what we're seeing too is that the number of these big exits seems to be certainly increasing. And the speed at which we're able to create these companies is certainly increasing. So what we say is that it's not about one type of capital. Now, yes, we did talk a little bit about venture capital up front, but we find that for any community and for any company, they need to be able to access and create and form a whole capital continuum. Because depending on the stage that the company or your company is at, you're going to need to access different types of capital. Because different kinds of people will assume different kinds of risk. Okay? So that's what's really important. Early on, the people who generally were going to need to back you are people who believe in you, probably more than the idea itself. Because the idea may be on the back of a napkin or it may still be in your head. And so usually the people who write those first checks are what we call friends, families, and fools. Now, another great source, particularly for those of you who are part of UCSD and part of the research community, is to get grants or foundation support. The reason we like those is because those are not what's called non-dilutive, meaning usually when people give you the money, they don't expect equity or a part of your company in return. So they allow you to explore the opportunity and minimize the risk before you bring in regular investors. So wherever possible, take advantage. There's many workshops that are done here at UCSD. Several of them are done through the Office of Innovation and Commercialization that's putting on this program today and through the series. And you can find ways of accessing these kinds of capital. So knowing what kind of capital for what stage you're at, it's what we call horses for courses, is really, really important. And then after you grants, there's other kinds of easily accessible capital, things like crowdfunding. Now, it's particularly beneficial for people who are building an actual product, because as you're crowdfunding for an idea, people can actually register their interest with you by making a capital commitment, basically by buying or pre-buying a product that you will deliver to them at the end of the campaign or when you're done. What's become recently into view are what are called ICOs. For those of you who don't know, that stands for Initial Coin Offering. These are crypto offerings. Those are very ambiguous now because particularly here in the US where they fall under SEC guidelines and regulations, and those have not been totally thought through, so some of the companies have been raising money in other jurisdictions. And then of course, business angels are generally a good source of capital. Now, business angels we're going to talk about in a second because they represent, particularly for a community like San Diego, a very, very important part of the capital ecosystem because they bring more than capital to the equation. And then you get more what we call institutional investors. The people who are not investing their own personal money, they're investing money given to them on behalf of others. And so it feels more professional. But it also comes with a lot of benefits, as well as some strings. And then strategic partners who, whereby your product or your service, what you're developing may help them grow their own business in some significant way. And then of course, as you get more and more mature, you don't have to give up your parts of your company anymore. You can take on debt because you can secure that debt with things like your inventory or your customer commitments. And so those are also great ways of doing this. So we're going to unpack a lot of this stuff in this talk today. But to understand kind of the birth of the venture capital piece of this, again, not the whole capital food chain, but venture capital. And the reason we do this is because when I talk to entrepreneurs, they very often think that the natural course of getting their company finances, you come up with an idea, you write a business plan, you pitch it to venture capital investors, you get VC investment, you grow and you exit the company at several multiples, over $1 billion, and you retire wealthy, and then you get back involved. And yet, as you're going to see, that is rarely the case. Those are certainly the black swans or the unicorns of the world and not the norm. But the birth of venture capital goes way, way back. Not quite to 1910, but you can begin to see the birth through the defense industries and the use of things like vacuum tubes and test equipment, and then eventually microwave defense, that there's something that happened, which is as it began pivoting into integrated circuits, that's when you saw the birth of venture capital, which then was able to put in these kinds of companies, and that then accelerated a lot of new kinds of innovations and technologies. Now, the growth of venture capital came because a lot of the capital in the United States was still very much concentrated, particularly investment capital. And of course, financial centers like New York, Chicago, around family foundations or corporate foundations that centered around the Ohio and Cleveland areas. And a lot of the East Coast family offices that had made their money during the beginning of the 20th century began to set up sometimes West Coast offices, or they had connections to West Coast offices. Many of these bankers were actually centered out of San Francisco and not what we now know as Silicon Valley for them. And then a few things began happening which were quite interesting, and there were a few West Coast IPOs. Now, these East Coast family offices that you see, many of those names are quite recognizable. Some of those family funds still have venture funds in place. Some of them have grown so large that not only do they have traditional venture funds, but they've also got social impact funds as well. And then, of course, when companies like Hewlett-Packard and others began doing well, it began getting the attention on the West Coast for what was going on. And you heard in the video at the beginning them talking a little bit about Intel, and then the company that preceded it, Fairchild Semiconductor. That was still during those times. So all of a sudden, Stanford University and the Silicon Valley, what was going on there was quite interesting. And these innovation clusters did all center, as I said, around a lot of these defense attributes. And what was interesting is that government was funding a lot of the research necessary for defense, and then the government was also purchasing a lot of these products that were coming out of the back end. So the pump was primed, as we say, for that kind of investment. And then there was a Small Business Investment Corporation, SBIC, active 1958 through the SBA, which then offered a matching program. And what that said was, if you're a qualified investor and you pass our diligence test, for every dollar you decide to put in, we will give you a match of those dollars. And we now call that leverage, because, wow, my capital now has someone else's capital in there, and so I've now de-risked my opportunity. Now, the other thing that was good is that you could pay back the government at a very favorable rate, and you could keep a lot of the upside on these deals. So it was a way of catalyzing early on some of these funds. And as I said, at one point there was 700 of these funds funded by 1965. It's not quite a particularly popular program now. I don't know how many of these funds still exist. It went actually through a bit of a bad phase, because as venture capital became very popular, the really good venture capital funds didn't need their capital, because they had no problem raising capital on better terms from outside investors. And so the people that were taking advantage of that program weren't quite as good, and so the performance of those SBIC funds went down considerably. Limited partnerships. You'll hear the term LP a lot. That just stands for a limited partner. When we set up venture capital funds, the way we do it is we come up with an idea we think is interesting, like we're going to invest only in technologies out of UCSD, or we're only going to invest in technologies out of UCSD in healthcare, or in therapeutics, or in cancer, or cancer diagnostics. And we form what's called the thesis. And then what we do is we write that up, and then we go out to a set of investors, and we pitch our idea. And then people decide to invest in us based on the thesis and what we're presenting, just like an entrepreneur would when they're presenting to another investor. The people who then decide to invest in us, those people are called LPs, or limited partners. And so as we began setting up these limited partnerships, we could also attract not only high net worth individuals, we could also now invest, get other types of people to put money in. And the general economics of a venture firm is what's called the 220. It just means 2% management fee. So if I raise $100 million, $2 million of that goes towards management fees to pay for the offices and travel and working with the companies, basically operational expenses. And then the 20% is whatever's left off after we exit the company and we have a pot of capital, we split it up between ourselves and the people who gave us the money. They get 80%, we get 20%, roughly. And that's the way it works. Now, what also made it really exciting is when there was, in 1978, there was a capital gains reduction tax. So now, with the carried interest, or the carried profits, interest is what we call it, that was now taxed as long-term capital gains. That made it even more interesting to invest. And then on top of that, in '79, there was a program called ERISA. Not important, the only thing you need to understand about that is it now allowed pension funds to give venture capital funds money. And so if you actually look at a large percentage of the capital that goes into the largest venture funds, a lot of it is these kinds of pension funds, retirement accounts, other things, because they represent a lot of capital in the market. Now, these were the early funds that were in the venture capital. What's interesting, and the reason I show this to you, because most of you who aren't in the venture space wouldn't recognize any of these names. What's interesting is that many of these people, or these families, and many of these legacies still exist. Normally in most industries, we see over a period of time that new players come in and displace the old players. But here we have a serial persistence where some of the same firms are still at the top of their game. The Sequoias and the Kleiners, even the Drapers, they're still at the top of their game investing in that. They've spent a lot of time building reputational and a track record. So now we can dig a little bit deeper into what we mean when we say angels or institutional investors. So with angels, business angels are generally high net worth individuals mostly. There are angel groups that are groups of high net worth individuals. And the reason they do this is because, well, one, it's a social activity. They love to be involved working with young startups. They love seeing the next best thing. Part of it's a give back for them to the community, but not in the most philanthropic way always. Their time is they want to give back to their community, but they still expect or would like to make money off of this. But the other reason they do it is because they're just not ready to retire. And when you look at a lot of the wealth that was created in the Silicon Valley out of the tech industries, most of these people had this kind of success at very early ages. You heard Mike Markkula from Apple, who's the first CEO of Apple, talk about him retiring at 32 years of age from Intel. And so what we find is that the startup world for a lot of entrepreneurs is like crack cocaine. Once they get a taste of it, they just have to be a part of it. But it's also one of the secrets of the Silicon Valley and why places like San Diego and Boston and other places that do a lot of innovation also work. Because when people have success, whereas in most systems when people have tremendous amount of success, they leave the system, they buy a beach house or a soccer club, and they, quote, retire. For entrepreneurs in the Silicon Valley or in the tech industries, when they have success, they come right back in and start their second company, their third company, their fourth company. Sometimes as an executive, sometimes as a board member, sometimes as a mentor. But there's this recirculation of knowledge, what we call time, treasure, and talent, that gets recirculated, that is the real secret for what's happening. And that encompasses a lot of these angels. And so as more of these companies that we saw on one of the earlier slides create a lot of wealth, those people then give back to the system. For those of you who've met one of our alums here named Taner, who endowed the Data Science Institute here at UCSD, he was the first outside employee hired at Facebook. So he had a lot of success. He's too young to really retire. So he is now an investment fund, and he gets involved with startup companies to get them started up. So he's kind of one of our big angels here in San Diego, and we're very, very lucky to have them. I already explained to you a little bit about the institutional funds, how they work. And the next one we'll see are the grants. And as I said, what I like about these, and what we as investors, when people come to us, like about them, is that you've actually built value in a company without having to give part of that company over to somebody else. To be honest, contrary to popular belief, a lot of people think that investors are in there to take as much as they can out of your company because it's a control game. Great investors are actually not that way. They want to keep you incentivized and excited, because if you're kind of working on a company for which the future has to be created, We need to make sure that everyone's incentivized to get up every day and be super excited about going to work and giving 110% and bleeding for that company. And so everyone has to be incentivized both reputationally and socially, but also economically. And because we can't always pay startups a decent living wage, enough money, then we compensate for that with equity in the companies. And so we like to find other ways of financing the company. Strategic investors are also really, really good. And usually balances of strategic and institutional investors can be a nice little combination. Now, the reason strategic investors can be good is because they, first of all, generally know something about your business. And very often the solution that you're providing them helps them grow their business or helps them solve a problem that they haven't been able to solve. So that can be very enticing to them. The challenge with that is they said, we always say, it's great for you to, you don't want to be monogamous, but you also don't want to be sleeping with too many companies. The reason is because very often if you get attached to one strategic partner too closely, and one if it's the wrong one, you cause you to lose momentum. But the other reason you don't want to is because if the world perceives you as only having that relationship, you'll never get anyone else from the other parts of the market, because they will assume that you're already taken for that. And so there's a bit of a dance and a game you can play. But the good part about this is you can add value to a company and what they're doing, and they can recognize that. And so very often the terms under which they invest can often be more favorable. Not always, but they can be often more favorable. Whoops, let me go back. As we mentioned, crowdfunding, the Kickstarters, the Indiegogos of the world. I'm not the biggest fan of these personally for fundraising. I know a lot of people use these platforms for fundraising. I like them better for testing out your hypothesis. You've built a product or a prototype, and you can use Indiegogo or Kickstarter to test some of the features and benefits of what you're doing, and then let the customers vote with their dollars as to what they find valuable. Do you sell more pink ones than blue ones? Do people want a fully vetted, expensive version, or do they want the minimal version that's more cost affordable? And you can test a lot of these things in real time, and it gives wonderful customer validation. And next week you're going to hear from a colleague of ours, Vidya Dinamani, who will talk about customer development and how you kind of do your customer and market traction assessment. And she will talk a little bit about this. As we talked a little bit up front about the ICOs, the initial coin offerings. This won't apply to most of you. There's a lot of interest in the blockchain and crypto financing and crypto offerings. It still remains to be seen how those are going to play out. We have one of our companies here at UCSD that was a spin out that was started by some undergraduate students. They actually did San Diego's first crypto offering, and it was quite successful. And they were using it, in my opinion, they were using it in the right way, and we could talk about that either offline or if we have time. And then, as we said, venture debt, private equity. We often hear this term private equity. Private equity is just a way to invest in the tangible assets of a company. We can actually look at these things and analyze them and assess what's happening. And it's very much the buy low, sell high mentality. Now, in venture, we invest based on the fairness model, because we don't know what the future is going to do, and so we have to assume that if you do what you're supposed to do and I do what I'm supposed to do, then we'll create a great company together. And because there's so many more known knowns in more mature companies, we can do the buy low, sell high. So I'm always trying to extract the best deal. With most capital and most deals, we do what's called syndication of the deal. And if you haven't heard that term, what that means is we only have so much capital and time available to us. And so just like you would do in your own retirement planning, we as investors do. We want to invest across several different kinds of opportunities at different stages, perhaps in different areas of the market. But in addition, we like to invest with people who complement our skills, because it's almost impossible to get all the skills you need in just side of one fund or in one person or one small group. And so by investing with other funds or other investment syndicates, It helps not only diversify our risk, but it helps us amplify the expertise and the competencies we can bring to the company's aid. And then, of course, banks, traditional. They don't offer much besides their capital, sometimes some connections and some introductions. But we just broke this down. Now, this slide is courtesy of a colleague of ours, J.D. Davids, and Smart Money Startups, and he also teaches some workshops with us at OIC, so you'll be getting kind of more information that digs a little bit deeper. But this just kind of breaks it down by the funding sources by stage. And we'll, of course, give you these slides so you'll be able to look at them a little bit, but it just reorganizes some of the same information I just told you in a slightly different way. Crowdfunding types. We talked about Indiegogo and Kickstarter, but of course, there's all kinds of crowdfunding sources, and it's growing every day. There's probably even new ones up here that have gone beyond this. The point of these last slides is it's our job in this class to not tell you what to do, but rather to show you what the options you have available to you and then educate you about them so you can make informed choices. A colleague of mine up at Stanford said power is all about having options. And what we're really trying to give you in this class are a set of options so you can make informed choices. And that we think is the best way for us to kind of help you on this journey. Now, in investments, as I said, most people just assume that you start a company, you get venture capital money, and everyone lives happily ever after. But as you will see, out of all the new companies that get created, you can see how it really kind of feeds down into the number of companies that truly get venture monies and, even more importantly, actually exit, which means they create some kind of liquidity event for the investors out of that. In fact, it looks kind of more like this. And these can be kind of sobering numbers, and that's the point of it. That venture capital money, as most people think, is not necessarily, in fact, it's probably in some ways the least desirable of the capital, but at times it can be some of the most important. Because as venture capitalists, a lot of the people who go into venture capital, particularly in the US, have operational backgrounds. And so many of them have actually started companies like this. So as you saw, Don Valentine, who is a big rainmaker at Sequoia, he was an operational person at Fairchild Semiconductor and had done really well. If you actually look at a lot of the top venture capitalists, they had been in operational roles or in sales and marketing roles before that. Again, just another way of looking at these same things. And you'll see at the bottom of this slide, you know, how many kind of companies go through an exit of some sort, and then you'll see what we call the zombie companies, the Walking Dead. We call these companies because these are the companies in our portfolio who haven't done so horrible that we just shut them down and close them out. They're doing okay, they're just never going to do well enough for us to make money back on them, or at least make significant money back. So we call those the zombies because they continue to kind of walk the earth. Okay, now we're going to go a little bit deeper into the mind of the investor. And this is a lot more of the mechanical stuff of investing. So, the first stage of any kind of venture experience, both for you as the entrepreneur and for us as the investors, is where we find deals. How do we source the deals in the first place? And this goes for angels as well as institutional. Anyone who is an investor has to start by finding the deals in the first place. So the first place we find the deals from other investors, people, particularly people we've invested with before, and even better, people we've invested with before who we've had a great outcome. Trust. Just like you do in your own personal networks, you trust your friends and you trust the experts in your network more than other people. We as investors are doing the same thing. Because what's really interesting about investment is that if we're good at what we do, we can always get more capital. The one thing we can never get more of is time. That's the great equalizer in the investment world. So we're really trying to figure out how we get the highest return on time, not only just the highest return on our capital. So that's why we go to those networks of trust. Besides the other VCs, we go to service providers, particularly law firms, Because often when you're an entrepreneur, the first people you have a conversation with are the lawyers. Maybe it's because you want to protect your intellectual property or you just want some advice. And they're the ones who then refer things over to us. I say that well over half the companies that I've been involved with, the referrals have come through the law firms and certain firms that I've worked with over and over and over again. The other one is just through different trusted groups like the angel investor groups, and then of course colleagues. Sometimes we do it through analysis. Now, this is definitely prevalent in the healthcare space where you get people reading articles, medical journals, papers, where you're looking at a lot of the research, and then you have people who are either drug hunters or diagnostic hunters, people looking for solutions. So they do them by reading research reports and others, and actually scouting. Some people actually do it from walking the halls of academia. There's a number of venture firms, and particularly successful venture firms here in San Diego, one of them being Avalon, where the investors actually would constantly walk the halls talking to academics on what they're working on. Then rarely but on occasions, the business plan competitions, the networking events, trade shows, things like that. Those have a much higher probability of clicking. Doesn't mean they aren't important socially, but they are. And then as investors, what we have to do is put all of this stuff into the top of a funnel and somehow get it to filter down. And so this just gives you a little insight into the mind of the investor, how they have to filter these opportunities. We have to use our judgment, our intuition. The earlier the deal is, we use a lot of our gut. And it kind of does it, not only does it, can I intuit or think it's right, but can I feel it's right? Because very often there's not enough data. As Mike Merkle was saying about Apple, it's not as if we knew how big the world was for personal computers. We could only gut check it and say, I could see that in some point in the future, everyone might be able to avail themselves of a personal computer, but there's no data to support it. So it's a combination of that. And then of course we have to read the plans, meet with people, do a lot of conversation, talk to other people. And then once we're convinced that there's something there, then we do what's called diligence. And if you hadn't, in fact, it's called due diligence. D-U-E and then diligence. And that's where we decide to climb deeper into the deal. That's where we kind of open up the hood and learn more about not only what it is you do and what it's about, but that's when we actually do sign the non-disclosures. And we can dig deeper. And that's when we spend, as investors, a lot of money and time on these opportunities. Any questions? Okay. Now, remember I said we have to manage our time very effectively. So then we have to, as we screen things, do all these balanced considerations. Not just the risk reward, but this kind of thing. Are we missing the next big thing? This can sound, God, do we need to get into blockchain today? And what do we need to invest in blockchain? And who do we need to invest in? Or do we sit kind of back more patiently and kind of wait and kind of learn and see more things? Because we have to manage our very scarce resources, because that's, like I said, our time we can't create more of. And there's only so many people in our fund. It also has to match the thesis and objective of what we're trying to do. So the closer the opportunity is to our experience base, the quicker it's going to resonate. Because when you pitch to investors, if you just go, a lot of entrepreneurs just go willy-nilly on all the investors. They just look at a list of investors, they just begin pitching to them. And then they get very disappointed because there's a lot of no's. You have to understand that there's a tremendous selection bias, and it's very human. It has nothing to do with your opportunity. You may have caught us on a bad day, or you may just be presenting something to us that we just don't know anything about. And so be careful of investors who just tell you that's a horrible idea. I can tell you in the years of professional investing that I've done, I've never told somebody that they have a horrible idea. Because the chance, I'm also insightful enough to know that that person I say that they have a horrible idea will be the next Facebook or Google something. And I just will not have had the wisdom to see the opportunity. I can tell you though that it's not a fit for us. Either because I don't know enough about the space and my personal time and cost of getting to know it may be too big. It may just not be interesting to me. It also may not fit the thesis. So there's lots of reasons that the investors could say no or might say no. Obviously, the quality of the opportunity itself, which means the team. So there's a lot of times we've gotten very excited because the team was so exciting. There was a healthcare deal that we looked at last year, and to be honest, as they began talking about it, we got information I didn't understand. It was literally like another language the very first time we talked to it. But the team was so phenomenal, then it justified the time to get to know it, because I was saying, if these people who are extraordinary and have exited their combined exits were the tunes of nearly 10 billion in exits between the entire team, we said, there's something there, we just have to spend time to learn it. Or the technology. There's some very, very interesting technologies that come particularly out of here at UCSD, and you go, these are really interesting. It's probably worth a little bit of time to understand them a little deeper. So then we create a scorecard. Now, there you're going to see a couple of different scorecards. One is this is an opportunity sheet, really, where the prospects come in and we fill out all this information. This is one of those things just to keep us organized, because most investors have attention deficit disorder, and so they can't remember the hundreds of deals they see in any one year. So what we do is we kind of categorize the information and we kind of log it in. We kind of want to know what your secret sauce is. Then what we do is we then screen it further, where we kind of bring it to the partners. We tell them what we like. We have lots of discussions. We vote on all this stuff. A lot of boring, what we call sausage making. And then, of course, we assign someone to lead the diligence on the deal, and we kind of dig deeper into that. And then, of course, we try to make a decision. Now, this is pretty much the same process for most investors. Some angels who are literally just investing out of their own wallet, they don't do a lot of this because they have no one to answer to other than themselves. So a lot of times they can say, I like you, I like the deal, I'm investing. Now, when we set the criteria, you have to understand that the investors you're pitching to might have different reasons for investing. Some people purely want financial considerations, return on investment, ROI. Other people like sovereign funds or community funds, funds you may access from the city, maybe just for economic development. Are you creating jobs? Are you employing students out of a university? They're willing to do that. Sometimes if you can leverage the institution's assets in some way, they may be willing to invest in you as well. And some are just philanthropic. What you're doing is going to save the world. We believe in backing you to save the world. So there's lots of different reasons. And the way people kind of score these things, and there is no hard and fast rule. This is more science than it is, more art than it is science. And we have to kind of mix these. But we have to come up with some process that at least we can justify. But usually it comes down to a gut instinct and a set of conversations. Now, as I said, most of us, when you first pitch to us, whether it's in the elevator or you come to our office, the first time we meet, we're probably not going to sign what are called non-disclosure agreement or confidentiality agreements. The reason is we see so many opportunities that we just can't possibly keep this all straight, and we don't even know if we're even interested yet. So before you tell us the magic sauce for what your company does, we're just going to have a general discussion of what it is and what it does, not how it does it. And we will suspend belief in your opportunity. In other words, we will be able to take at face value that if you say you can do something, you can do it in the first meeting. And if we really like you and we think that this is interesting, then you get the next meeting. And of course, the business model canvas is really important. And I think I shared with you that in the week we did the business model canvas, that it's also a phenomenal tool for VCs to use in deconstructing. Because if that's what you use to construct your business case, it's a great thing for us to deconstruct it with. So we're going to ask you some of the same questions about what went into that. Now, Andy Grove created this, one of the founders of Intel. There's nothing magic about this slide. It just basically says it's always good to get early into a really big field. Personal computers, like Apple did. Be early on, be a leader, market leader in something, as opposed to getting very, very late into an industry that's closing down or that's not doing much. And that really requires you to know a lot about the industry and the trends in that industry. And these often, look, when we do opportunity evaluation of your idea, these are definitely like icebergs. Everything we can see is just that small little piece that sits above the water. The real dangers for us, or the real things we have to consider, are trying to understand everything that sits below the waterline. So these are just a few of the elements in it, and we'll talk more through several of them. But of course, the economics have to make sense. What harvest means is the exit value and the exit time. Because when people give us money, they have an expectation of getting their money back. And it's usually a 10-year period or somewhere right around that. So we have to make sure investing in you aligns with that same harvest period. That you have a strong competitive advantage, not only today, but through the life of your deal. So that when we exit your deal, you still maintain that competitive advantage, or you've grown it in some ways. As we mentioned during the Business Model Canvas week, the two aspects of what you're doing is value creation and value capture. And too many companies, too many entrepreneurs focus just on the first one. How do we create value? You need to focus just as diligently on how you capture the value. And of course, a lot of that goes to the management team and the human capital, the people you're going to hire, the culture. And then of course, we look for fatal flaws. Because what we find, although there's probably 100 things that could go wrong in your business, there's probably only 2 or 3 things that truly matter. Because if you can't nail those 2 or 3 things, you just don't have a business. For a company like Amazon, it was superior logistics and superior customer experience. It was kind of that simple. If they nailed those 2 things, they'd be able to work through a lot of the other things. And if you go and read the very first annual report that Bezos wrote for Amazon, he states that very explicitly, that the core of their business are those 2 things. And every year since then in his annual report, he always comes back to that and how what they've done reinforces those 2 critical elements. So an attention to detail and fanatic about execution on that. Now this is where it gets more to the human side of what we expect from entrepreneurs. We love great entrepreneurs and great teams, but they have to be emotionally competent. They can't break down at the sign of the first roller coaster dip, because all great companies are going to go through this. It's just the fact of life. In fact, there's a saying that great companies never die of starvation. Great companies always die of indigestion. Almost always from too much opportunity, being defocused, not knowing where to place their resources and talents and time and attention. Many of these things you hear over and over again, but we have to be convinced that people will buy the product and hopefully buy it again and again at a premium price. So that's the other thing. How do you know if the dogs will eat the dog food? Video will dig into that more deeply. The solid team with super high integrity. You can't build that. You can't even buy high integrity. It's either there or it's not. And so you've got to find people who do that, because your values have to be highly aligned. And those are some of the problems that you saw over the last several years with companies like Uber, where there was supposedly some bad behavior that was occurring inside of the company, and that threatened the very existence and the profitability of the business itself. The IP positions, passion, the next bullet point under entrepreneurial passion, relentless imagination, flexibility, coachability, and pushing hard at the edges. We find that the greatest entrepreneurs that we back are living paradoxes. We talked about this paradoxical personality traits. That they're incredibly optimistic, that every morning they wake up, the world can be so much better and they know how to make it better. But they also have this productive paranoia where they're sure someone's right over their shoulder trying to take their business, trying to take their employees, trying to take their car, that there's something about it. And they balance this to where it becomes this productive paranoia, where they can turn it. I can't remember who said it, but there was a saying that only the paranoid survive. But you have to have a compelling business model that offers venture scalability and, of course, an attractive risk-reward balance. It always comes back to the risk-reward balance. The other thing is we talked about in the first class with design thinking about the proof of concept, but of course we also have to have the proof of relevance. How can you demonstrate that people care? And once you do, we always say, how many miracles have to happen? Because in every company, there's some sort of miracle that usually has to happen if we can just make X occur. And that's one of the things that Steve Jobs was so amazing about. He got his employees to stretch well beyond their capabilities. He said, I need X done. They said, it's impossible. He said, but you're going to do it anyway. They said, but it's not possible. He said, but you're going to do it anyway. And when he said it enough time and walked out of there, they made it happen. So that's the concept of the miracles that have to happen, and great leaders can get their people to create those miracles. Now, this is why we say no, why investors say no. A lot of times entrepreneurs are just not coachable. And I learned this, by the way, the hard way. Spending a lot of time and even some money with companies where we thought, God, we can get them to see our point of view. If we just work hard enough, we can make it happen. And we found the hard way that you just can't. And it was one of the biggest disappointments. A very well-known venture capitalist in the Silicon Valley, John Doerr, who's of the League of Don Valentine, who you saw in the video. Someone asked him at a conference if it was, is the secret to being a great investor to be dispassionate, to not have emotion? And he says quite the opposite. He says you fall deeply in love with the companies you work with, but then you have to learn to get over heartbreak. And so that's it. So we have to bring as much passion to the opportunity as you do. And we just have to be able to get over it when it doesn't work, which is why we spend so much time understanding the people and the quality of the team. Of course, the size of the market and its trending, all that is really important. Sometimes people pitch us ideas and the market's just not big enough. You see that a lot, by the way, on shows like Shark Tank, where people are pitching stuff. But a venture firm in the traditional tech, Silicon Valley venture firm, most of those deals aren't that interesting because they're just not big enough. Doesn't mean you can't make money in them. They just don't have that attractive risk-reward balance for a lot of people to do. Barriers to entry just refers to what allows you to succeed and keep others out. It may be an intellectual property position, but it may be that you've already got a first mover advantage. There may be some barriers of entry to other people entering the market. It may be that you worked in the industry for so many years that you have some inside baseball knowledge that others just don't have. So that's really, really important. The other reason we say no is because the exit is unclear, or the traction is unclear. That actually happened to us with one of the deals we looked at. In fact, it's a company that I'm still an advisor for. I still have equity in the company, but I didn't invest in the company. But the reason is they met every criteria. Phenomenal team with a history and track record where they had created a lot of value for their investors. A very interesting product and market that you absolutely knew was going to happen. We just didn't know how quickly it was going to happen. We just knew that what they were providing was going to create a lot of value for the consumers and the marketplace. We just couldn't get our heads around it how quickly the market would actually adopt that solution. And sure enough, they've struggled with that. The market adoption has been much slower. It's not that we were smarter, it's just that we just didn't have enough knowledge to be able to make the right decision. And then sometimes other investors. If we don't like the other investors in the deal, we'll pass. Or if they aren't of the quality that we want, we'll sometimes pass. And when you think about from the investor's side of the table, so you're the entrepreneur, you're going to be presenting to the investors. The only thing we're hearing and seeing is risk. Everything you're saying, little risk. And we're not looking to say yes to your deal. We're actually looking to say no. Because we're predisposed. Because human beings biologically are wired to minimize loss before they maximize gain. That same VC, John Doerr, who I was telling you about from Kleiner Perkins, he said, I've never lost money in a company I didn't invest in. You also didn't make the huge upsides. But again, it's one way of looking at it. So when you think about risk, there's kind of the 4 stages of risk that we have to worry about. The first one is risk identification. What are the risks? Once we understand the risk, then we step over to the next box, which is risk assessment. What do we have on the table? What do we need to know? What do we know? And you're going to see this in a future slide. Then the next one over is risk allocation. Which can we pawn off on somebody else? Are there partners, other people we can bring in who can take some of that risk off of our hands? And then what's remaining? How do we manage and mitigate the risk that's left with us? And everything about our deal is all about risk. The best deals have risk in them. Again, it's risk-reward balance. We've never seen a deal that's pure upside with no risk in them, or certainly very few. So great deals do have challenges. We just have to understand them. These are just 12 of the boxes that we spend time in understanding the risk factors for. But really, it comes down to 4 fundamental things that we look at. The first one is the idea itself. which includes the technology, the IP, the defensibility, all the stuff in there. Will it hold up over the life that we need to do it to get our money back? The next box, the people. Can they truly execute? Can they build the teams around them? Can they create the right types of relationships, access the right kinds of networks to build it? The next box over, do they have the right business model? Because again, it's not all about value creation, it's about value capture. So can they get these products into the hands of the people who will buy it and return the value back to them? And the fourth one, which is the hardest to assess and the most important, is the timing. Is the timing even right? When you're riding a surfboard, you have to catch that wave at exactly the right moment. And these are the things that we spend our time understanding. What have to we confirm? What's just not knowable? A lot of times when you do things, there are just some things that you will just never be able to know because they either haven't been created or it's going to take time to create them and you can't know them. Things will only be known in retrospect rather than in foresight. And then what is the risk to us of not knowing something? As I mentioned in that last company, the risk to us of not knowing when the customers would actually adopt this was just too high for us to make the decision to invest, so we decided not to. Are there any major risk factors or opportunity killers? There always are. And then how do I learn and validate? Just as you're going to take your business model canvas and use it to form hypotheses and then go test those, we have to do exactly the same thing for you. These are the questions we're going to ask you. Remember, when you come in and pitch us, there's 3 questions you have to answer when you pitch us. Why you? Why now? Who cares? It's really kind of that simple. If you can nail those 3 questions to us in the pitch to us, we will actually make good progress. But then we're also going to want to know, do you want to be rich or do you want to be king? And the answer is not both. Are you an empire builder or are you a builder of impact and scale? We've had a number of entrepreneurs who have come to us. In fact, one of the deals we passed on that we were syndicating with another firm here in San Diego, one of the conditions that the entrepreneur made is that they had to be guaranteed that they were going to be CEO for a period of 5 years. We can't make that promise because we don't know if they're the right person. And so we have to have a conversation that you may be the right person. If you can, we're going to back you and give you 100%. If you're not the right person, we have to have that conversation. You have to be ready to step aside. Again, we don't know the future. We're going to build the future together. That's the difference between startups and more mature companies. In startups, we just don't know what the future is. We have to create it. And therefore, we don't want to put in stone too many things that we have to walk our truth back on. What motivates you? We're going to ask you a lot of questions. In fact, when you come in and pitch to us for the first time, before you ever get to your presentation and open up your laptop, we're going to talk about you. We're going to go for coffee, go for a walk, something. Because we're going to want to know what got you to this place in the first place. What motivates you? Are you doing this for fame, for wealth? And there are no right or wrong answers because they're your answers. We just need to know what they are and make sure that they align with us. So please don't BS the entrepreneur or the VC, because it's like in any relationship, where you put on your good face to impress the other person, then you kind of get down the road and then you take off the mask and you're a different person. That just creates more discord than you can possibly imagine. So be authentic, be truthful, be you, and that's the best way to be. Now, we want to see how good you are at testing hypotheses and assessing your judgment skills. So we may have talked about this in one of the previous weeks, but as I said, when you come to us and say, I've just developed this phenomenal new cancer diagnostic, and the first 2 things we're going to go after is pancreatic and ovarian cancer. Excellent. You've done all the assessments, all your business models and your pro formas look great. And then I'm going to ask you, what are 2 other cancers you might have looked at? Why did you decide not to go after breast cancer or testicular cancer or some other cancer? How you think and test hypotheses tells me more about you and how you operate than what actually always just sits on the final document. And so we're going to try to crawl inside of your head a bit. Is the entrepreneur a good communicator? We've actually found that the very best entrepreneurs are also the best storytellers, because you're trying to get us excited in a future that doesn't yet exist. and try to get us to go with you on that journey. And the only way you can do it is if you can paint the image that you have in your head, if you can get us to paint that same picture in our head. And one additional thing, you have to get us to understand what our role is in that future. What role do I play in your future or of what you're doing? And if I can visualize and understand that, then I can resonate with it. If I resonate with it, if I can establish both the resonance and the relevance, then I can believe in you. And when I believe in you, I can write a check in you. And that's what's really so important. Can you build a following? A vision and team? Because again, you have this storytelling. You're trying to create a religion, a culture in your company around your product. As I displayed in the first week when we talked about design thinking, I showed that one slide, the religion of Apple, that you basically created a movement. You have to do the same thing in your company. Unless, of course, you're building just a commodity product, just something that everyone else is, and somehow you're able to do it better. And then can you attract, motivate, and empower others? Can you get people to follow you? Now, the other thing we're going to want to know is how committed are you? It's what Angela Duckworth calls grit. What they found is in her studies with entrepreneurs and with other types of people like this, that there was no correlation between IQ and EQ, but they found a huge correlation of success with what was called grit, the ability to stick to something and have this tenacity to follow things through. Are you optimistic, creative? Are you ethical? Sometimes those things aren't immediately apparent. Everyone says all the right things, but you can watch through the behaviors. A lot has been written about in the Silicon Valley over the last year about some of the bad behavior in some of these VCs along the same lines as the Me Too movement. And that's been getting a lot of attention. Why didn't we know about this earlier for what's happening? Are our values aligned? It's not, again, not good or bad. We just have to understand if our values are aligned in the company. Do we both want the same thing? And that's often where these things kind of break down. And can you execute? Can you delegate? A lot of entrepreneurs, this is where they fail, is on the delegation. They're so passionate and dedicated that they think they're the only ones who can make things happen, and they try to do everything themselves. But from a scalability standpoint, that can't grow a company, because great companies are never grown by individuals. They're grown by teams. And so that's really important. Can they be resilient? So when you do get bad news, you lose that customer, you miss a payroll, can you bounce back? Can you keep going forward? That's really critical. And then do we see any red flags? Now, of course, it's always best if there's a proven track record, but there isn't always that when you back entrepreneurs. The reason we like track records, even if they're failures, because you learned on someone else's dime. And what we found with great entrepreneurs is they hate losing, and when they have lost, it just feels so bad that they try not to repeat that same experience. But just as important is the integrity, the vision, the execution, leadership ability. And this is leadership ability not necessarily as just management, but leadership ability is being able to lead a group that will follow, what we heard from Simon Sinek. Now, this is the next phase. One of the slides in your deck is going to be around a competitive analysis. It's also one of the places that entrepreneurs fail miserably in our eyes. They often put a competitive matrix up there or a competitive analysis that shows who's building exactly the same product that they have. But competition is a lot broader than that. It's not only who's competing for exactly that same product, but who's competing for the attention of your customer, who's competing for the resources you're going to need, for the talent, for the distribution channels, for the salespeople, everything you're having to do. Also understanding in your competitive analysis, what role does culture play? That's something that was a hard lesson for companies like Uber and even Google to learn when they went in China. The culture plays such a strong, important role that by going into another culture and not fully understanding that culture, you can often have difficulty, or there can be barriers to entry that you didn't immediately anticipate. And then the last one, do you have the ability to warp gravity? Think of this kind of as marketing. The one thing that US entrepreneurs do better than other entrepreneurs in the world in general is the self-confidence that they possess. The ability to, again, influence perception and reality of what's happening. An example is there was a company in the Silicon Valley called Bloom Energy, it may still be around, that builds these solid oxide fuel cells. The technology itself, nothing new about it. but they packaged it up, made it look really interesting. And on one of the 60 Minutes segment, this venture capitalist I told you about, John Doerr, was presenting on 60 Minutes. And he was talking about this wonderful technology that was going to change the world, even though we knew, because we had been offered the chance to invest in it, that the technology wasn't particularly new. It had been around for quite a long time. It just had, like I said, been repackaged. But then what they did is on the 60 Minutes segment, they showed a thing with eBay and Google. They showed pictures of eBay and Google and said, eBay and Google are actually using these solid oxide fuel cells. They're putting them in to manage some of their energy needs. And isn't it amazing? Well, part of the reason is because John Doerr had a relationship with both eBay and Google. He was on the boards and was an investor of them. So they literally just give the boxes to them and say, can you test these things out for us? And by the way, we're going to take some pictures, if it's okay with you. And they do that, and then you put it up on a screen, and then the next day, everyone wants to get in the deal. This is amazing. If those guys are in the deal, I've got it. And so warping gravity is also influencing what we call FOMO, fear of missing out. Once you realize that everyone's doing something, the zero-sum mindset kicks in, and that if they have it, then that means I'm going to lose out. So do you have that ability to kind of create that perception around your business? Now, the next slide you're going to be looking at is, of course, the market. How big is the market? And there's both macro and micro. What are the general trends that are happening? How well is the economy doing? If the economy is doing well, then people have more discretionary money to spend. They take a little bit more risk in the kinds of things they maybe make purchases that they otherwise might not make. Or if the market is a little tight, maybe people focus on just the commodity things, the things they absolutely have to have. So understanding the market trends that are happening both now and as you go into the market. But then the micro things. How big is your market? Who are the people you're serving? How do they buy? Where do they buy? If you could have 100% of the market, how big would it be? And then if you begin slicing it, how big is your part of that slice? And are you really offering people an aspirin or a vitamin? The reason we use that analogy is because if I've got a very, very bad headache, I'm really not looking for a vitamin. I'm looking for something much stronger. So if the market has a truly big problem, offer them something that can kill that problem or take care of that problem, not merely just address part of it. And then can the intensity of their pain overcome natural market inertia? Which means, they've been doing the same thing for over and over again. And very often your solution is going to have to cause them to replace a behavior. They've been solving a problem in some way. You've got to get them to change the way they were solving that problem before. Simon Sinek said, look, you can trip over those first early adopters because they naturally gravitate to that. That middle segment is the one that's really hard to go after, and that's what that has to do with. And of course, you've all been coached on the business model, so you're experts in this, and this is how you're going to test your hypotheses and your differentiations. And the last week, as we mentioned, of this class, those of you who wish, we're going to ask you to, if you want to volunteer, you can put it up, and you're going to present your business model canvas, but we're going to let the other students in the class actually ask the questions and pull it, deconstruct it, and help you kind of create a better one. The money, pretty straightforward, but it's actually, although it seems pretty straightforward, there's a lot of elements to it. It's not only what strategy you're going to do. Are we going to go for easy money, or are we going to maybe wait and try to get a little more money? How often do we get money? Do we get lots of little small amounts of money, or do we just go out and get the big money, give up a little bit more of our equity in the company now, but we don't have to worry about fundraising? How much do we need? Do we try to get in a little bit more than we need so we don't have to struggle? Because it's like remodeling your house. It always takes more money and more time than you think. And what valuation? What am I willing to give up to others for that? And then what is the exit strategy? What am I going to do with this company? Because if you're going for a professional investment, we don't want to hear that this is a lifestyle business that you're just going to kind of run forever, because we'll just never get our money out. And so what is the exit strategy? You're going to exit, maybe go IPO, maybe form partnerships. And depending on how early we invest in your opportunity, there's we call it back of the napkin calculations. Because when you think about it, someone gave us money. So we've got a little pot of money over here. And let's say there's 2 of us in the fund, to make it easy. Well, the 2 of us can reasonably only manage maybe 5 companies each. That'd be a lot, actually. So 3 to 5 companies. Let's say we're superstars. We've done this a lot. We can manage 5 companies each. So that's 10 companies. How many companies do we have to look at to get to the 10 companies we actually invest in? And then at what stage do we invest in them? And if we've got $100 million over 10 companies, that's roughly 10 million per company. And usually when we invest, God, we can't give them all the money up front because they're like children that you're raising. You give them a little money now, but as they grow, they're going to certainly need more money. And so all these kind of calculations go through our head. And so we often start at the exit of the company and then work our way back to think about what we think is a reasonable valuation. And so some of our other workshops that we do on this, we actually dig deeper into these kinds of investment mechanics, the math behind what we're doing, including the term sheets, the valuations, all this. So I'm happy to sit with you guys either one-on-one or after class to go through this, but we probably don't have time to dig deeply into this right now. This is just another way of looking at a particular deal that you're going to do, where $1 million in the 5th year. You can see what the revenues are, but this is again a back of the napkin calculation, and it's just kind of how we arrive at these numbers, these pre-money valuations. So it's probably no accident that many of the deals we look at kind of exist in the $3 to $5 million range for their first kind of A rounds. There are certainly some that are higher. Uber's initial round, I think, was somewhere just north of that, and I think the one they did right after that was like 11 million. But these aren't necessarily crazy numbers. It's what is a fair valuation for what you're doing. Now, I put this in just to make us look a lot smarter, even though there's just some fancy numbers. But again, this is just another way of doing valuations. It's a way for people who do valuations to justify the amount of money they're charging you to do it. Again, we can walk you through this, and we're going to provide you these slides. So it's probably not necessary to walk you through all the math there. Don't want to put you to sleep any more than you are. One of the risks we showed you on the risk analysis is product risk. Product risk is a big thing. Have you proven out your product? Have you built just a simple prototype showing that it can do what it can do? At what stage is that prototyping? Is it just your idea still, and you need the money to take that idea and build an invention? Or it may already be some kind of crude invention you now want to productize and turn it into some kind of product. If you build a prototype, is it a laboratory prototype that works in the confines of something very stable where you don't touch it, but you've shown it works? Or is it ruggedized where it can work in the field, or if you put it in the hands of your customers? All of these things tell us things about your product and the risk that you're doing. We talked about IP, so we don't really need to go through that. One of the terms I don't know if she mentioned last week, if she did, I might have missed it, is this concept of freedom to operate. Did she mention that? She did? For those of you who didn't catch it, the freedom of operate is saying you may have some really, really great intellectual property, but someone else may have some intellectual property that surrounds yours, to where even if you do have something really great, you still can never get it to the market because someone else's technology stands in your way. So that's what they call freedom to operate. Do you really have the ability to kind of do it? And that can be very costly. So we as VCs, when we do our diligence, once we sign the non-disclosure, once we get excited about you, we begin spending a lot of money on things like this, understanding it. Here's some other IP resources that she may not have given you last time. The first one is really kind of interesting. It's how to read a patent in 60 seconds. So for those of us with ADD and have to get through these things really quickly and are looking at hundreds of deals, that's a really good one for us to do because it helps us understand the claims that are being made inside of a patent, so we can at least begin to understand. It won't give us full comprehension, but it'll give us a sense. Market traction, we already talked about that. How do we know? That's the why, who cares? So we had the why you, why now, and who cares. The reason why now is so important is because you have to create a sense of urgency. You have to assume that investors are looking at lots of deals. And if they think they can wait and defer a decision on investing in you, either till you have more customers, more revenue, more proof points, they're going to do that. So you have to create some sense of urgency. Again, that you have to create that fear of missing out. Like the deal's moving closely, every great VC is in the deal. If you don't give me an answer by today, it's gone. These things are great motivators. Human beings hate missing out on stuff. They hate avoiding loss. The other types of things that can be wonderful motivators or can go towards your traction is there a legislative or compliance need? When they had the Healthcare Affordability Act and California Care, people had to sign up for insurance. That created a mandated need. So anytime you have mandated needs, that can be a great driver of not only compliance, but of market traction for what you're doing. Do we have visibility to the pathway through the exit? These are for people who have more regulated types of deals that they're working on. 510K versus PMAs, existing reimbursement codes. We talked a little bit about that last week, but what we need to understand is what is the environment like. We have to get comfortable with that. Also on the go-to-market strategy, how do you actually reach the customers? Some people now can just literally set up an eBay shop and sell products. Some people may set up a storefront in addition to it. Some people may hire salespeople to go out to other businesses to sell their product. Some people, instead of having a dedicated sales force, may have other people. They may have a hired sales force that someone else is. So we just need to understand these go-to-market strategies. And of course, there's different places for the research behind all these assumptions you're doing. Now, there's primary and secondary research channels for you to do on, and we're going to use these as well. For the finance. Now, you have a great advantage here being at UCSD, and that you can access a lot of databases that either can be at lower cost or sometimes for free that the university may have access to, that if you were on the outside, you'd have to pay for. And so they can be wonderful things. I know the Office of Innovation has some of these databases. But we look at just generally kind of some of these macro reports, what's happening in the economy, all the way through very industry or sector-specific reports. We also kind of look at different thought leaders and listen to podcasts and meet people. We look at what trade organizations put out. We go to conferences and seminars just like you do. But these are great places for you to do your research, for us to do our research. And then, of course, some of the secondary research channels like the Googles of the world, the search engines, but also very expensive databases like CB Insights and Mattermark. We tend to live in those too. I had a couple of slides up from CB Insights, just because they have some of the best market data for us and what we do. And then, of course, once we decide that we're going to write our check, we have to understand what our capital risk is on that, which includes the valuation. Are we paying too much for the deal? Are we not creating a fair enough deal to where the entrepreneur is not incentivized enough? How are we going to budget this thing? When are we going to, what do we think is reasonable? And also, are we working to what's called a capital efficient company or a capital traditional, like a hardware company where you have to buy a lot of equipment and put things on shelves? Or do we like doing software companies where you can build a prototype for very, very little money and test the idea? The other thing that you have to understand that when we as investors invest in a deal, one of the things that we're always thinking about is who's putting the next money in. So one of our deals that we said no to was not because we did not like the deal and we even satisfied the timing question. What we didn't have a good sense of who's going to put the next money in. Because as the company grew and needed a lot more capital, we could still keep our part of the capital going, but we couldn't put all the capital in. And we weren't sure that there was enough capital in the next round. This is, again, not a hard and fast rule. This is the scorecard we were talking to you about. I kind of overweighted this to make a point, more so than this is actually what we do. We literally weight very, very heavily on the people on the team. When we find extraordinary entrepreneurs, we weight that pretty heavily, and of course, the ideas, the team, all that other stuff is really kind of critical. We're going to go through these next slides very quickly, only because they put me to sleep. I don't know if they're put you to sleep, but these are all the numbers, the income statements, all the projections, your pro formas, your assumptions, the salaries. There's lots of great places. There's a lot of resources we can bring and help you with this stuff. There's a lot of research you can do on your own, like salary.com. There are a lot of these databases that allow you to do it. And don't forget, most companies we invest in are pre-revenue companies. But if you're post-revenue, then your numbers look more heavily like this, where you've got a lot more to dig into on your balance sheet and your P&Ls and profit and loss statements. And then, of course, this is what we're going to do. So besides looking at your business plan and your business model, having that conversation and looking through the management presentation and getting excited, we're then going to come and visit you. And when we come and visit you, we're not just going to talk to you, we're going to talk to your employees. So be prepared for us to walk the floor. We may even go to some sites. We may go to your customers as well and have conversations with them. If your product is something that's in use in some, let's say, like a hospital or another setting, we may actually go to the setting where it's actually used and just observe, not even tell people we're there, and just see how people are using it. So there's a lot of things that we have to satisfy ourselves with. So a lot of people think that the investor's role is just to kind of get excited about what you're doing and then give you money. No, we have a lot of things that we have to dig into as well. In your business plan or your business model, this is of course what we're going to go through. We already told you that, and I'm going to give you in just a second a template that you can use for putting your business model together, actually your presentation together. These are the references, and by the time you're done, as you see, we're going to probably know your credit score. We're going to know your marital and your social history. We're going to look at Facebook, see who you talk to. So understand that everything is on the table when you do this. If you are in a business where you're making money, of course, we're going to look at how you've tracked. You said you were going to do X. Did you do X? How far off were you? Why? Those kinds of things. The return, our financial analysis, there's a term at the bottom there that says IRR. That just stands for internal rate of return, because we as investors are not judged merely by, for every dollar we invest, how much do we get back. There's also a time component we get charged on. So it's not only how much money did we deploy and get back, it's over what period of time, and that calculation determines how good we are as investors. This last thing is for more mature companies. This is where we look at your insurance and your leases and all that kind of stuff. But then when we go to do the deal, that's when the real negotiations begin. In one of our other classes where we are able to dig deeper, we actually do negotiation simulations where we actually have a group of students actually negotiate with each other for the terms of the deal. So there is something that gets presented called the term sheet. There's generally kind of two stages of the term sheet. Before we dig in too deeply on the diligence, like we like what we're doing and we think we're going to work with you, we're going to generally have some high-level terms discussed with you, because it doesn't make any sense for us to spend all the money and time getting under the hood, dating you, going to visit your parents in the day, until we know that there's an end point that we could at least agree on, which includes the valuation and all these other parts. So the term sheet will be something, and one of the tools that we will give you is sample term sheets and how to look at them, what do the terms on the term sheets mean, and that will kind of help you a lot understanding that. And of course, we are always available as resources for you to kind of bounce some of that back. I've done that for a number of the students here and faculty. When they've gotten a term sheet, they said, can I discuss this with you? What do you think of the terms? What are the things that we have to be careful of? Is there anything unusual in here? Anything that we're missing that could hurt us? And very often there are those things that can get hidden in there, or that people can use to take advantage of someone who doesn't know as much. We're also going to want to know who your board is. Sometimes as investors we want representation on your board, sometimes we don't, but more often we do, because we'd love to be in the conversation about how you're growing, plus we think we can help you. Who's representing you legally, and are they doing a good job? We'd rather not your brother or your uncle being a lawyer, unless they're a really good lawyer, doing the work. And then of course there's a lot of documentation, but then also discussing what happens after you write the check. Because what's interesting about the investment and the whole investment process is that once we write the check to you, believe it or not, we've lost all control. In fact, there's a misperception that the investors, the VCs, have all this control over the entrepreneurs. Actually, we don't. Once we write the check, and let's say even if we're a board member, we have one vote on that board versus all the other board members. And generally, that authority really only goes to hiring or firing the CEO. There's usually not much more beyond that. That's why we say that our role is to influence without authority. How do we kind of help you in a way to grow the company beyond what you've done. So I'll stop there for a second and take any questions before I show you the template. Any questions? Yeah.
So you mentioned like how you find companies or people to invest in, and it was really interesting. What would you recommend for someone who's like just started a company? Do people hit you up on LinkedIn and just say, "Can I buy you a cup of coffee and tell you about my company?" Or do you prefer to wait until a company has like buzz about it or something like that?
You do both. In fact, my favorite thing is there's an old saying that when you ask people for advice, they give you money, and when you ask people for money, they give you advice. I'm a big fan, particularly those of you who are associated with an academic institution like UCSD. It's a wonderful way to socialize an idea. Now, you can also over-socialize an idea where everyone's heard of it, particularly if you don't execute well on it. But there's nothing wrong with when you have an idea or you've got the base of it, say, putting a group of people together to test your idea on. We call them the friendlies. We've done that actually for a number of companies here at UCSD. When we think that they're ready to pitch, before we put them in front of investors, we bring some of our friendly investors from the community who are there just to give constructive feedback. It's kind of like what Connect does as well. And it's a way just for you gathering insight and feedback. And by the way, when people give you feedback, please understand that majority of it is just opinion. It's their observations. It's their versions of hypotheses. Same things that you guys are putting in your business model canvas to test. Very often what they're saying back to you, some of it is fact, some of it might not be. If you don't know the answer to a question, please don't BS your way through the answer. Say, it's a really good question. I'd be happy to get back to you on that. And by the way, we're going to be testing you on that. I think we mentioned that in one of the previous ones. We're going to see how quickly you send us back an answer to what we're doing. This was actually put together by one of my business colleagues. Bill and I worked together in a fund. Bill's known for being one of the co-founders of Garage Technology Ventures, which is still around, that he co-founded with some other colleagues, and one of them being Guy Kawasaki. For those of you who have been in the business world, Guy is a pretty famous guy because he was the Apple evangelist when Apple was growing. And they had a very successful venture fund, and they invested in companies like Pandora. And Bill put this really great presentation together on how you kind of create that really impactful story. Because what you realize is when you're pitching to somebody, most people tune out pretty quickly. Because at every point in time, we're trying to figure out relevance and resonance. Why is this person talking to me? And does it matter? Do I care? And so you've really got to get them very, very quickly, because that's just the basic human anatomy. So we engage, of course, the head. There's an intellectual argument, which is the why you, why now, who cares? But there's also the heart, which is get me to remember you, get me to care about you, get me to do something, get me to set up the next meeting with you. And of course, the third's kind of the gut, the soul. When all three of those begin kind of agreeing, that's when we kind of get that good stuff going. And of course, the heart's more important, as we said, because if you can get me to care about you and remember you, that's everything. The best entrepreneurs are the best storytellers. The best storytellers touch our hearts, not only our heads. If you go, there's a incubator in the Silicon Valley called StartX. It's Stanford's student accelerator, and they actually literally have a pitch elevator pitch, and it's actually the elevator that you take up to go up to meet with all the VCs, and you get to practice your elevator pitches. So you can read this. What you're going to see is that this puts you to sleep halfway through the statement. And the reason is lots of data, lots of figures. I don't care. I care less. A lot of technical jargon, a lot of words, acronyms. The number of entrepreneurs who come in and pitch us acronyms, and they haven't even told us what the acronyms mean. Our eyes are rolling back. We're checking our phones. We're just thinking, how do we get out of there? So Bill just calls this getting to wow, because that's really what you're trying to do. You want someone to go, wow, that's kind of cool. That's pretty important. That's really what you're going is that visceral reaction. So what Bill says, and I agree with him, ignore the typical wisdom. You start with a problem, you tell a story, you explain your solution, you step A, step B, step C. And for those of you, I don't know that anyone in here took, at the Ignite conference, we did a storytelling workshop on how to do this. And no one buys this. No one starts with that. I mean, you would never create a movie this way. Why would you create your movie or your story this way? So, in 20 seconds, you've got to be super clear. Really, really laser clear. To where there's no possibility that the person can't get this. You got to be compelling, you got to be credible. Where a lot of entrepreneurs lose us is often on the credibility. If we just can't, again, that's belief. Do I believe you? If I don't believe you and something's off, I'm going to be looking for every reason to hit the exit. So you need this at all times. Talking to customers, talking to employees, talking to investors, talking to your grandmother, anyone you're looking for. So what is the one or two things you can do that no one else can do? We had a startup pitch that was like this, a great company, again, another technology out of UCSD, and I set up a meeting with them with one of the top investors in healthcare. And these guys had developed a phenomenal cancer diagnostic, and we put them into in front of one of the top cancer investors. And they brought with them 3 physicians who combined have exited cancer diagnostic companies to the tune of several billion. And they had half an hour to pitch, and they spent the first 20 minutes of the pitch trying to tell them how many people cancer kills, or how much money it costs, how many people. And the investor was very, very kind. He says, I'm going to stop you here. We have a very short period of time, but we're some of the experts in the space. We know it probably as well, if not better than you do. So why don't you spend your time telling us 2 or 3 things you can do that no one else can do? Get us excited about that. And so what can you do better than anyone? It's also what we call our competitive strategic advantage, simple language. The reason they call it the Wall Street Journal language is because they said if someone was writing an article and creating the headline for what you do, what would that headline say? Because obviously the headline is what grabs everybody, and it's what makes people want to remember. What is the benefit that accrues, and to whom? So your listener is always the center of your story. You are not the center of your story. This is, again, one of the biggest mistakes that entrepreneurs make when they pitch. They make it all about them. It's always about the person that you're pitching to. It's about the customer, the person who's going to use it. How are they going to benefit, and how is it in their best interest to be listening to you in the first place? What makes you different? Again, what is it that you can do that no one else can do, and how does that differentiate from everybody else? That competitive advantage. We talked about the competitive analysis. We are unlike others. You put those 3 together, you kind of get that. Now, when I give you the template, you're going to see that the template still has elements of that old system that I was telling you about, where you describe the problem, the intensity of the problem, and the solution, and all that stuff. So again, use your judgment on what works well. Also, just Google best venture presentations, and you'll see a number of the presentations that people have used. The one I'm going to send you is actually from a company called DocSend. And it was backed by Sequoia. And so they did an analysis based not only on their presentation, but on the presentations that Sequoia, the venture fund, sees, because they wanted to understand how long, when someone reads a presentation, how much time do they spend looking at this page versus that page? And what are the pages that people generally remember? And so you'll see all the data and statistics on that. So these are some alternative approaches. Tell a story, paint a picture. There's several different storytelling plot lines you can do. One is the hero's journey, where you have ordinary people going on a quest, meeting interesting people, and going through trials and tribulations. Another one is what's called the future narrative. Imagine if, or 10 years from now, people will be doing X. That's exactly the pitch that Jobs and Wozniak gave to Merkle when they pitched Apple. Imagine 20 years from now, everyone having a personal computer on your desk. What would that look like? Use analogies and metaphors. One of the reasons, when I'd written my first book and we put it out in the market and it had a lot of success, at first I couldn't understand why it had been so much more successful than other books that were probably better written and were probably more important than what I had written. But the fact is I use a lot of metaphors and analogies in the way I speak and what I do. And what we find is that allows people to create an image in their head. You let people create movies in their mind. And by doing that, they can see and experience your future along with you. And that's what then creates that resonance, not just the relevance. So use those wherever you can. If it makes sense, you can always drop really big names. But don't overdo it and don't use them insincerely. If you do, you'll be looked at as a fraud and it'll actually hit your credibility. People say, oh yeah, the number of entrepreneurs who say, oh yeah, we already have term sheets from this person, the big names. First thing we're going to do is call those people because chances are we know them. And then we find out that they've never even heard of you or that they were exaggerating that. That's a deal killer. Remember we talked about red flags or deal killers? That's one of them. Keep it simple. What I suggest all of you do when you put your pitches together and you test them out, whether you do it with friends in small groups or whether you do it with professionals, you'll notice that after you've done your presentation several times, people will keep asking certain questions over and over again. That tells you two things. One, you may want to address those in the presentation if people are asking those questions. And two, I always keep a list of questions that people ask, and we create what's called an FAQ, frequently asked questions. And then we actually put that as part of our presentation decks we give to people. These are the questions we didn't have time to go through, but these are the questions everyone asks. So do that. Do not lie. These are the top 10 entrepreneurial lies. Our projections are conservative. We only get 1% of the market. We had someone said the healthcare market is this several $trillion market. That's a complete, I don't know what that means. What does that have to do with you? What part of that market are you and why are you telling me this? Now, this is where I may differentiate from Bill a little bit, but we have a world-class team. It's fine as long as you immediately validate that, but everyone's going to say they have a world-class team. The reason you don't say you have conservative numbers is your numbers are your numbers. And the one thing we all know is that they're wrong, but your numbers are your numbers. They're your best guesstimates, and you may have even done several versions of them. This is what we think is if we have X amount of money and X amount of time, this is one range of the numbers, and if we really kind of are able to get this traction, we're able to get here. But when you say, these numbers are conservative, it's kind of a rookie mistake in our book. We have no competition. That's a deal killer for two reasons. You either have no idea who your competition is, you've been lazy, or you don't have an opportunity worth us looking at. Because if no one's thinking about doing it or competing with you, it's probably not worth it for us to look at. No one else can do what we can do. Now, it's true that no one else might be able to do certain elements of what you can do, but people can generally still solve the problem. They may be solving it in a different way. So avoid the hyperbole in what you do. But also, don't be so timid that you're afraid to be bold. So it's that kind of very fine line. All we need is 1% of the market, or in this case, 2% of the market. But these are just typical things. Look at the last one. This is what we were just talking about. I'll be happy to hand over the reins to a new CEO. They tell us this. And these are just some, we'll give you these slides, so we'll give you some online resources that are available to you. Any questions? And then I'll just show you the last. So this is what I was telling you about from DocSend that they put together. Because they wanted to understand why some funds, some companies get funded, why some don't, what were kind of the critical elements. So they worked with the folks at Harvard to put this together. And as you can see, they examined 200 companies that had raised about $360 million to look at this. Some of the top venture funds and companies were involved with this. And again, I'll give this to you because you'll learn more from actually spending time and absorbing this rather than just me going through it quickly. But spend some time really kind of looking through this. But these are the statistics that from the early fund stage. This is how many investors. This is basically the data they were able to kind of pull together. There's another interesting report that you can look at too called the Startup Genome Report. That was done by a group including participation from some professors here at UCSD. But the first report looked at 20 years of startup data and said, are there certain elements that are common between successful startups versus the ones that weren't successful? Is there any way to kind of understand? And of course, there certainly were. So some of them were quite intuitive, like teams. So first of all, teams of entrepreneurs are usually more successful than single entrepreneurs. Teams that have one business and one technical co-founder tend to do better than those that just have two technical or two business co-founders. I mean, these all things make intuitively, but they were able to empirically validate and about that. This just kind of tells you how many people had to, here's some of the findings that on average, the companies that got funded had to contact 58 investors, do 40 investors meetings in order to raise 1.3 million. And it took them roughly close to 13 weeks. Now, I would imagine that depending on the market timing, this could be longer or shorter. And their deck is roughly 19 pages in length. And most people, when they read it, look at that. They only spend about 3 minutes and 44 seconds. And that's if we actually like your deck. If we don't like it, we're going to spend a lot less time in that before it goes in the circular file or in the that. So these are kind of the takeaways. Keep your deck short and to the point. Keep them actually simple. The graphics and everything else you're doing really simple. Of course, raising earlier funding is going to take you longer than raising a more mature type of deal, just because there's more risk involved. It's harder to validate. This just says try to raise from a seed firm before you go to angels. They tend to make quicker decisions. The angels will tell you differently, and maybe in San Diego, because we have one of the best angel networks here in San Diego, that might be slightly different. More does not equal better. Focus on getting the quality introductions. So one of the things I like my entrepreneurs to do is look at my LinkedIn account and figure out who in the network would be the best to do. But before I make any introduction, you better have qualified that quite a bit. Why is it in their best, why is it in the person I'm going to introduce you to, why is it in their best interest to take your meeting or to look at your deal? What's in it for them? And it better not be just, this is a good deal for them to invest in. How have you already validated? Have you looked at the other deals in their portfolio, what they've invested in? How can you add value to their existing investments? Have they already invested in the space that you're in and they know something about it? These are some of the things you can qualify if you do some of these kind of friendlier meetings. It's not just about you look at a list of investors and just begin randomly hitting them, or you look at the shortest distance between 2 points and you connect to those investors who you know someone for. Qualify it and explain how it's in their best interest to be investing in you and how this fits with what they do. Spend a lot of time on your deck. We find the decks do make a difference. There's two kinds of decks we work with entrepreneurs on: the leave behind, the one that they socialize, and then the one that you're going to narrate over. Those are two different ones. On the narrate over, you're not going to have lots of words because you want them listening to you and relating to you, not the deck. Don't put your deal terms in your deck. This last one, really important. A lot of people will tell you, yes, put the deal terms in your deck, or we expect X valuation. Don't. It's a conversation. It's a negotiation. It's different. Ultimately, the market decides what your company's worth. You don't. And so kind of leave that out. And that doesn't mean that you don't have the core part of your deck and then some backup slides around it. As I said, you'll get this. And then this is just the table of contents. So I will literally just let you look at this. We're not going to go through it now because I'm sure you all want to get going and go home. But this will tell you how much time people spend on each slide. They'll also tell you which ones have the most impact for what you're going to do. How to order the slides decks. And you can say this is between what DocSend did versus what Sequoia had recommended them to do, and why. And Reid Hoffman, who's been advising, Reid Hoffman is founder of LinkedIn and a great investor and with Greylock. Also, how much time they spend, as we said, it was 3 minutes and 44 seconds on the ones they actually like. And you have to say which pages matter the most. So spend time on these particular pages. Of course, the financials we have to spend the most time on, only because it just takes the longest to go through them. The team, obviously looking through a team doesn't take as long as looking through numbers. But the team, you can see, has a disproportionately high amount of time we spend on them. Because again, we back people. We invest in people who can execute on an idea. These are some good example pitch decks, and you can actually go find some of these online. So these were just a few, but there's a lot more great ones, and I'm happy to send you some more. And then just how long it's going to take you, how much time you're going to need to allocate for fundraising, for the preparation for the fee. Now, of course, we have resources here at UCSD to help you connect to these. And please strive for the quality, not quantity of investors. While it is a bit of a numbers game, your time is quite valuable. And if you do a lot of the upfront work, you'll save yourself a lot of the heartache on the back end. And then know what to do and when to give up on this. And then how much to raise. So a lot of the things we just discussed in the previous part, you're going to go through. And then this has a little bit of the angels versus the seed firms. This is an opinion of this particular group that put it together. Do not take this as holy gospel. Again, the purpose of this and all of our classes in the certificate is not to tell you what to think. Is to teach you, is to give you options and teach you how to critically think. We're going to expose you to a lot of people's opinions, and it's up to you to filter through them. We won't go through this because it's a lot of words, and you can spend time reading it. And then depending on whether you're raising your seed round or your Series A round, typically when you raise financing, you start with like grants and proof of concept funds, and then you get your pre-seed round, you get your seed round. You then do a professional, which is your first professional round, which is an A round, and then they're lettered after that, A, B, C, D, E, beyond that, so we can keep track of them. Any questions? Because like I said, there's no reason for us to go. Yeah?
So I've been told that when companies go to their C round, they typically leave, if they start here in San Diego, they typically leave, maybe go to the Bay Area. Now, they go to the Bay Area because that's where the money is coming from, and they want you, you've got people that want to camp out close to those companies, they want those companies to be close to the investors to be able to monitor what's going on, or for other reasons, for talent? Or is that
Why are you asking? Why do companies from San Diego move there, or what?
That's what I'm told, yes.
Okay, well, there's both, but I mean, there's more capital up in the valley. It's just that's a numbers game, and there's just more capital up there. Now, there's also talent pools to draw upon. Very often, investors can often require that the company move close to them, because if they want that weekly interaction, particularly if you're an early stage company, they would love to be working with you face to face. And it's just the opportunity costs are just much more affordable if I can drive 20 minutes, or if I can put you in our incubator and just visit you every day, or if you have a question. Because a lot of success in these companies can be serendipitous, just random collisions and interactions that you see. So that's part of the reason. It's not because people are truly lazy, it's just because the opportunity costs are higher. Now, that said, though, San Diego is getting a reputation as a great place for some wonderful technologies, and so you can certainly build phenomenal companies here. It just depends on the type of what you're doing.
So you see that turning, because
Yeah.
that's been something that Albert Pisano was concerned about, and some others.
We're still concerned because, again, we don't have as much capital as we'd like to have. And by the way, it's not just the capital. Because there's a big misconception. If you just take a bunch of capital and drop it over, these fertile startup fields, that all these companies just begin growing. But far more important is the insight, the knowledge, the wisdom of the people that goes into it. What mistakes to avoid, how to talk to people, how to pitch. Those are the real critical elements of gaining the market traction, being close to customers and interacting with them. But that's which is why we think that why we see that correlation between the tenacity of entrepreneurs is because the ones who have the real high stick-to-itness and will get on a plane at the moment's notice are the ones that just naturally have self-selected to have a higher probability of success. And I see that we're kind of approaching. These are the takeaways. Again, keep it to these 20 pages or fewer. Yours may be fewer. You may see advice from others. Again, on average, that's about how many pages they are to get through everything. But that's different than what Bill Reichert was talking about. The getting to wow is about the story you're going to tell around it, rather than what needs to necessarily be included in some of the decks, and also how you kind of order it. And I tend to agree more with Bill that the most powerful pitches that I've heard have been where someone starts off by telling me kind of something that they've done that no one else can do, and gets me excited about that, because now I'm listening very intently to the rest of it. These are the things we talked a little bit about before. So these are the kind of key takeaways. This is a slide that was earlier on. And you can look up more resources online, and we'll send you after the class more resources for you to look at. Any questions before we close it up for the night? You guys have been quite quiet. Usually for this class we get lots of questions.
A lot of questions will run over time.
Oh, so you can kind of pitch us anytime or ask us. Have fun with the funding, and of course we're here to help as you kind of get through that part of the funding. Next week is all about customer discovery and development, like how do you actually pitch your customers, how do you kind of do that market analysis. Video is amazing. In fact, we're going to be not only videotaping the regular way, but some other folks are going to be coming in to see how they can capture that particular session as well. So you'll be seeing that. Happy to answer any questions, and thank you so much for being here tonight.